Well, thank you all for coming. This is, as Tyler pointed out, GIC's 8th time here to the Wyoming-Idaho area. We're always pleased to be back, especially this beautiful location up here under the tent, under the big top. We're really excited to be back. I would like to invite you all to some upcoming meetings we've got. Manuel Balmaseda is working on a meeting for us in Mexico City. That will be on October 4th and 5th. That's going to be involved with Bank de Mexico in the morning, and then we'll be going to the Bolsa, the stock exchange there, the following morning, and we have some private meetings with institutions for those that have got an institutional bent. Then on November 3rd, we're going to be in Little Rock, and on November 6th, we'll be in Fayetteville. And then November 9th through the 13th, we're in Kyoto and Tokyo, Japan, for those that like the Orient. And I think that's all we've got scheduled right now. February 8th, we'll be at the Bundesbank in Frankfurt. Working on that conference right now, and I think that's it. All right, we'll do more, but I just don't know what they are right now. I'm happy to invite you here for, unfortunately, our opening speaker, Charles Evans from the Chicago Federal Reserve, was unable to make it because of weather over Chicago yesterday. I don't know if you guys have looked at a weather map. I mean, it's sitting over Buffalo right now, and it's like a massive angry storm that shut down O'Hare yesterday. So he was unable to make it. But we do have our second panel with us today. And we're going to start, what's our order? We're going to do John Silvia from Wells Fargo is going to talk about the United States. And then Manuel is going to talk about Europe, Latin America. Greene from Manulife is going to talk about Europe, and I'm going to talk about China. So with no further ado, I'm going to let John Silvia come up, and I have reminded John that this is a public forum. He's more used to working under Chatham House rules, where his gloves are off a little bit more, but we'll see how vociferous he gets.
Well, thank you very much, Michael. And Jill, I thank you for being the human teleprompter for Michael, because if you didn't know the dates, he would have no idea. And to finish out the Mr. Olson's roast, Bradley, Manuel, and I do thank you for giving us the biggest fish out at Trout Valley. There was a new rule this year which we advocate that we keep going forward, whereas if you caught a fish with a little tag on it, you would get whatever the tag said, and the tag said you could take the biggest fish from the next group. Al was in the next group. He had the biggest fish, and so Bradley now takes ownership of that fish, and we appreciate your presence. So I have a very abbreviated presentation in terms of my traditional style. I try to keep with the time limit, but you are welcome to contact Jill or Susan or whatever and get a copy of my slides. That's all public information. Again, the economic outlook for us is pretty straightforward, but the one thing I mentioned to Wells Fargo clients repeatedly is we sort of gotten into this groove. And as many of you know, when you get into a business with a groove, you sort of get complacent. Every year is 2%, 2.25% growth in the United States, and we sort of start straight lining that projection going forward. And I think for most business people right now, that is the biggest challenge going forward. For investors, it sure is the biggest challenge. If you ever listen again to Bloomberg, Michael on Bloomberg or CNBC or anybody else, time and time again, you kind of get this optimism that's sitting there expecting the market to continue to move forward, and we know that we always deal with cycles in real life. In terms of fiscal policy, we still think something will happen, but certainly not on the scale that what was promised. Monetary policy, I think Chair Yellen did a good job yesterday trying to explain, at least in my belief, that there are no rules. Life has no rules. I mean, you just can't do that. Sometimes you drive down the highway and, if you're driving like Bill Dunkelberg at 75 miles an hour, Sometimes you have to slow down a little bit. Sometimes you speed up. The weather, there's construction, there's accidents, there's all kinds of things. And you can't, in my opinion, you cannot conduct monetary policy as a rule. And the way I phrase it to most of my clients is, you know, Captain Barbosa was right. It's not a rule, it's more like a guideline. You know, I think that's an appropriate way to look at that. So we'll talk a little bit. This is real GDP. The consumer is key for us, not only for our institution, but I think for the U.S. economy. The consumer benefits from more jobs, an improvement in wages, an increase in wealth, both in terms of real estate and financial wealth. And I think that was pretty solid in terms of what we're seeing on the American consumer going forward. I think credit is readily available in most areas, but I think Chris Whalen will have some comments on credit distribution. We are concerned with subprime autos. I can't imagine Land Rover has a problem with subprime auto lending, but there is a challenge there. There is some overbuilding in multifamily. When I look at Charlotte and I see that the amount of apartments put in place has exceeded the occupancy for the last 3 years, I do get concerned that there may be some overbuilding in apartments. And as many of you know, retail still is going through its restructuring and downsizing and reevaluation of what they're going forward. The employment numbers are pretty solid. The unemployment rate to us, and I know some of you do use a Phillips curve type framework, the unemployment rate has not been useful to forecasting wages. For us, wages are perfectly consistent with low productivity and low inflation. So we take a much more micro fundamentals point of view in terms of looking at wages as a function of productivity and inflation. If you don't have a lot of inflation, which we don't, if you don't have a lot of productivity, which we don't, then you can't expect wages to be paid. And I, of course, listen to all these people about getting wages up. Well, you can do that through higher inflation, but it would be nice to get some improvement in productivity. This is, again, what we see in the employment population ratio, nowhere near what we've seen before, but I think, quite frankly, most of us realize there is a generational change in terms of attitudes. Not only in terms of debt payment, but also in terms of work, the willingness to work, the expectations with respect to work, and the globalization, I think, has also made a difference on wages overall. This graph simply illustrates a fundamental challenge I have in economics, and maybe some of you have the analysis as well. Oftentimes in economics, it's easy to say that the level of something is higher, and so therefore things are better. My suspicion is I look out at this property, there are probably more homes here than there were a year ago, 2 years ago, 5 years ago, 10 years ago. And the article in the Wall Street Journal talked about the level of consumer debt being at an all-time high. Well, that's great, but you got more people. And you also have inflation. So if you're measuring the nominal total value of debt and you're not adjusting for population or inflation, you're not measuring anything. But oftentimes one of our problems in my business, maybe in your business as well, people will throw out the level. And you're saying, well, that's great, you got more people, but is there any growth here? And one of the great challenges for Wells Fargo, we have a lot of communities that have more people, but the rate of growth of those people has really dramatically slowed down, and it's making a difference to us over time. This is the household debt service ratio, so this is pretty good for us. People have changed their attitude. This was a topic that came up at the Trout Ranch. People have changed their attitude with respect to taking on debt, and a lot of people have paid it off, and the debt service ratio still remains remarkably low. Yeah, sure, if interest rates were to go up a little bit, this would change, but I think it would be nowhere near what it was 10, 15, 20 years ago overall. Debt delinquencies, this is another topic that some of you are probably aware of. Subprime auto delinquencies have picked up. Student loan debt is a secular problem, a long-run problem in terms of the debt. As I mentioned to a couple of my friends over coffee this morning, the New York Fed publishes a great series of articles on student loan debt, and if you're really interested in that topic, that's a good source to go to and access. But I think at this point in the cycle, credit delinquencies are not telling us there's a big cyclical recession forecast probability. But as you can tell from the graph, when you have that recession, it shows up pretty quickly. So that's, again, one of our challenges. This is another issue, and again, it feeds into the auto problem. Used car prices are actually declining, and they've been declining for a while. That affects the residual values on cars when they're turned in after lease, and that affects the contract, and it's a very complicated process. But one thing I would probably disagree with Chair Yellen a little bit. I think the weakness in inflation is far more pervasive than just wireless. I think if you look at import prices, non-oil import prices, if you look at medical service prices, you looked at used car prices, you looked at, again, obviously wireless services, a lot of prices are much weaker than generally expected. So we do look at core inflation picking up gradually over time, so I think Chair Yellen is right about that, but I think it's, again, going to take a while to get that inflation numbers up. So as a result of that, housing starts have improved, formations are there. But here, again, I would say to you, yes, I do expect the Fed to increase the federal funds rate at the end of this year. I do not expect the Fed to be able to follow through on 2018 and 2019 in terms of raising the federal funds rate as aggressively as was implied by this dot plot. I know that some people have interpreted Chair Yellen's commentary yesterday and now this morning as implying that they will not pursue that goal as aggressively as they would. Some people have argued, no, you're totally misreading it. Maybe I'm misreading it, but I kind of get the impression that looking at the inflation numbers, it's going to be hard, again, for you business people, it's going to be hard for the Fed to pursue an aggressive policy of raising that federal funds rate. A lot of discussion on what the neutral federal funds rate is, and we can have a long discussion on that going forward. But I think, again, this dot plot's a little bit, even now, a little bit too aggressive for 2018, 2019 going forward. Some regional trends. We get a lot of regional data, and one of the interesting things, well, the question I asked with the credit union people right off the bat is, where are you located? And it's interesting. They're in like 5 different states. And some of those states are rapidly growing. But it's interesting to see the regional disparity going on. Senator Cotton this morning, when he was asking a question of Chair Yellen, he pointed out the regional disparity that goes on. As many of you know, I live in Charlotte, and you can tell by my accent, I'm from Charlotte. But, you know, when I drive up the road to Hickory, North Carolina, it's a whole different world. Absolutely. So you can get employment data and unemployment data by county in the United States. And if you ever want to see the county map, just send me an email. I'll send you out the county map. It's just absolutely fascinating. Here's GDP growth by state. You can see Washington and Oregon, Utah right at the top. Pretty strong economic growth overall. And this is employment growth by state. And as I said, and these are metropolitan areas. And as I said, you can get a copy of this presentation if you need to see an illustration of trying to develop your business plan in terms of what states to go or what metropolitan areas to go to. And I've got 50 minutes left in my presentation. But that's it for me, and I'll turn it over to Manuel.
Okay. Thank you. Thank you very much, particularly from Bronze Buffalo, for inviting me again to this spectacular place and to GIC. And next for something completely different. We're going to move away from the U.S. and developed economies to Latin America. The slides will be available, so I'll go through them. I'll just skip through some of them probably. But I just want to leave you with 2 messages, only 2. The first one is Latin America is much more than Brazil, Mexico, and Argentina. Right? But when we talk about Latin America, it seems like we only concentrate on those countries. And the second one, which is the bad part, is that like everywhere else in the world, and I'll leave that for last, we talk a lot about economics, right? But at the end, politics is determining almost everything in some of these countries. And what everybody, if you listen to Bloomberg or look at the newspaper or whatever, you read much more about what's going on in Brazil in the in the political front, than what is going on in the economy. And that's the case everywhere, and that's good and bad. It's good because it brings things to the forefront so things can be cleaned up. It's bad because actually there is a lot of good things going underneath in a lot of these countries that are really hard to see because of the political atmosphere. So that's why I say beauty is in the eye of the beholder, right? There are countries that you might like more or less. And depending on your business, you might want to go to a really large country like Brazil or Mexico because size matters. And depending on your business, you might want to go to more stable countries, more financial dependent countries or tourism countries. And normally we don't talk about those too much. And as you realize, since I only have 15 minutes, I won't talk about them too much either. What about Latin America? What we see is that actually Latin America in 2016 was probably the only region in the world that was in recession. Right? The world, developed world, Europe and the US grows around 2%. Right? For once, actually, Europe grew more than the US. But the big growth is actually in Southeast Asia, and Latin America seems to be in recession. Right? And when you look forward, going to 2017, the projections are not much better. Right? Latin America continues to be the country that's dragging growth everywhere. So they're saying, why should I be interested in a region that actually doesn't grow that much? Right? This is why. The first reason is when you look at Latin America, two countries, Brazil and Mexico account for 60% of the GDP. If you have the large seven, that's actually 90% of GDP. So literally, when you're looking at the average, you're just looking at what Brazil and Mexico are doing. That's it, pretty much. So that negative growth that you see in Latin America is actually based on the fact that Brazil is in recession. It was in recession in 2016. It's in recession. It will be actually out of recession barely in 2017, but it's not generating any growth. It's the fact that the U.S. is pulling Mexico out, but they're both growing very slowly, 2% growth. And it's the fact that Venezuela, which is one of the largest countries in Latin America, is dropping at an 18% rate. So when you have two of the largest countries in the region, Brazil and Venezuela, and particularly Venezuela falling by 18%, the region is not growing. But you can see that actually the number of countries growing in the region is 25. There are 32 countries in the region, just in case you didn't know. Right? And of those, 16 are growing above 2%, and obviously 12 are going above 3%. So actually you can find a lot of dynamic countries in the area. Right? The question is that different countries follow very different rules in Latin America. You have countries which are very much pro-market, other ones are actually not quite pro-market. You know? And plenty of countries are dependent on commodities, while others are actually very independent of commodities. They're actually commodity consumers. And in that context, when you look at the ranking, you realize that some of the largest countries, particularly Brazil and Argentina, till very recently Argentina, they're actually not implementing very pro-market measures by any measure that you look at. It doesn't matter whether you look at the World Economic Forum or any other type of measures. So they're very controlled economies. Obviously, I'm not mentioning Venezuela because that's in a different category by itself, right? And in both cases, and in particular more so in Venezuela, they're very commodity dependent. And guess what? Over the last few years, what you had is a huge price drop, as I will show, in commodities, right? And if you have economies which are very rigid, very depending on what the government does, which are the anti-market, oh, I don't like to call them anti-market, not pro-market economies, sounds better, you got a problem, right? Of those, Mexico is actually one that is, of the large ones, more pro-market, right? But it's still very influenced by commodities, in spite of the fact that they don't export. They're dependent on commodities because the financial accounts, their deficit accounts, the fiscal accounts depend on oil exports, and to an extent it's important. But you have some other big countries like Chile, Colombia, and Peru, which they are very commodity dependent, so they had a shock, but they're very open and pro-market, and those guys are growing. Not only are they, and just one thing, Argentina is slightly moving towards the right, towards the pro-market measures with the Macri new government. Actually, I think we are going to Argentina sometime, right, in the next year, right, to see whether this is the case or not, because it's a very interesting country. It's 11% of the region, and it seems like new things are developing, right? And that's going to be very good news. Let me show you just a couple of charts very quickly. That's what happened to commodity prices. When you have countries like Peru, which are metal exporters, or Venezuela, which are oil exporters, and your only or main source of income, which is that export, drops by 50, 60, 70%, depending on the, guess what? You're in trouble. The nice thing is how you react to it and how is your economy prepared to react to that. And in that case, what we have is some economies that were very prepared and some that were not. At the end of the day, in the region, you can divide in several areas, right? And actually, there are alliances. One of them is Mercosur, which is the old traditional alliance between Brazil, Argentina, Paraguay, and Uruguay, which are all there. But guess what? Those economies were very rigid, not implemented the good measures during the expansion, and therefore their economies are dropping significantly. There is a new alliance, which is a kind of funny alliance because it includes Mexico, Colombia, Chile, and Peru, which they don't even share a border. And they signed the Pacific Treaty, in which they incorporate not only trade, commerce, trade liberalization, but also financial liberalization, and so on. So they move beyond anything. It's like a new type of treaty. You don't need a border because nowadays you don't need to. Goods is not what matters. It's services and it's financial that really drives the economies. Therefore, what you're showing is pro-market measures. Think about it. Both in this alliance, you have countries like Peru or Chile, which are very commodity dependent, much more so than Argentina and Brazil, and still they're growing. And they're growing because their economies were able to adjust because of the measures. Others, which I live there as other South American economies, like Ecuador and Bolivia, actually Bolivia is doing okay. Usually they are tied with Venezuela, but I didn't want to put them together because Venezuela dropping 18% would make everybody else around them look really bad, but they are not doing it. And the last one is Central America. If you look at Central America, in spite of the crisis, in spite of everything, there was no crisis in Central America, literally. Their growth is 4.5%. In some cases, the growth rates are Southeast Asian growth rates. They're not commodity exporters. They're actually commodity importers. They have really good trade deals with the US and with others. And not only that, they have a huge source of tourism income. And those economies are doing very, 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 very well. But even those countries that are not doing very well and that are more anti-market, this time around have reacted much better than in the past. They've allowed their exchange rates to depreciate significantly to the different shocks instead of controlling and intervening in the markets. And that allowed for the traditional flow in Latin America. It was the original sin that Hausman called it, and actually it didn't matter what happened, you just had a stoppage of funds. Suddenly, if nobody wants to bring money into the country, it doesn't matter how well you're doing, your country collapses. Because of the measures that they were implementing, nothing like that happened, and even so, they had the worst recession around them, the Great Recession, and the largest drop in commodity prices that affected them that they had in decades. And still they were able to sustain it, and they were able to sustain it because they allowed market forces, in particular I have here the exchange rate, to adjust for that. It was a shock, but it was adjusted. I'll give you a simple example. The day before the election in the US, the exchange rate between Mexico and the US, the peso exchange rate was 18 something. After the election, obviously you had all this talk about renegotiating or dropping out of NAFTA, immigration, all that. The peso went all the way up to 22. It depreciated over the course of a month, 18%. Do you guys know where it is right now? It's back below 18. So it made back all that room that it lost because of the election. It's made it back. Why? First, because they didn't get nervous. They didn't react harshly. Second, because people came to realize that there was a lot of rhetoric in the administration or in the election process that once things settle, there are things that you do and things you're not going to do, right? And actually the economy is doing better, and Mexico is not doing great, but it's growing over 2%. It is a good business. So the exchange rate appreciated. So in the past, probably they would have intervened much more sharply or something, and that probably would have been a good idea. And with that, the other thing we have in the region is actually inflation went out of control, but they all reacted by raising rates, those that had inflation problems. Even so, the United States, Europe, all these other countries, I think I spoke last year here about how the monetary policy in the developed world actually was kind of forcing the hand in Latin America, right? They did, but for once they said, look, hey, sorry about the word, but the hell with it, right? If we need to raise rates because we need to do it, we'll do it, and that's what they did. And you look what Brazil, Colombia, whatever did to control their internal domestic inflation and pressures, and they did. And now that Europe, actually not yet, we'll hear from Megan, but the US is raising rates and whatever, you see countries like Brazil or Colombia already lowering rates. You know, they went in the cycle ahead of the US and independently of what the Fed does, which I wouldn't have anticipated because traditionally they've always followed the Fed. The only one that continues to follow the Fed is Mexico, and they're ahead of it. They're already thinking about lowering rates while the Fed is raising rates. Right? So that's a nice dilemma that they've solved correctly. But not all are good news, obviously. There's something that John mentioned that we have here as well, is debt. Right? Debt has gone through the roof, and in particular in countries like Brazil, they got a huge fiscal problem. Not only they're accumulating debt, their deficit is over 8%. Right? And that's one of the issues that is going to be pending going forward, and one of the issues that is going to be restraining some of the larger countries in the region in a big way. I'll skip through the current account and whatever. So just giving you the numbers, what we think for this year and the following 5 years. At the end of the day, what you have is those countries that were growing okay, those countries you saw in the Pacific Alliance, they will continue to do okay in spite of commodities, commodity prices not going up as they would like or else. They're not going to have very, very, like rapid growth anywhere, but, relative to the world, they're doing okay. And countries like Brazil, Venezuela, whatever, I don't want to put them in the same page because Brazil at least is going to be zero growth, and Venezuela is still going to be in recession at least for the next 5 years average, but they're slowly coming out. I'll mention that at the end. Our forecast for the next 5 years actually is that Brazil growth will finally pick up to around 2%, 2 point something, right? Mexico is around closer to 3%, and if the reforms do well, they'll do somewhat better. Politics have a lot to do with it. They've learned. They're in the middle of a political crisis right now, and yesterday they passed the labor market reform law, which nobody expected. They are bickering about whether they impeach the president, whether they just put the old president in jail, Lula, who was, the old famous Lula. Everybody loved Lula. Now he's in prison for 10 years, right, because of corruption. In spite of all that, they are continuing to do some reforms. Some of the most important reforms, obviously, they are not going to implement in the short term. But it tells you that at least there is some dynamism, even in spite of all this noise. Obviously, being from a building materials company, and I have to look at one of the biggest challenges for the region, which continues to be infrastructure. Right? It doesn't matter which measure you use. Part of the problem with Latin America, and particularly in this world of lower commodity prices, is that they don't have the infrastructure to make their commodities competitive. I think the case in point is Colombia, where they got a lot of natural resources. However, the logistics are very complicated, and they don't have the infrastructure. Therefore, that's a big challenge that they have to look for, that they have to face in the forward. I wanted to, since I have only a couple of minutes left, I wanted to say something very quick on two things. First is, what are the main worries? The first one is obviously protectionism, right? And I wanted to address here why Mexico, why so much emphasis in Mexico from the side of the US. It's obvious, right? It's your closest partner with Canada, but Canada is almost part of the US. So, but the truth is that you had a trade imbalance that really was not caused by Mexico, it was mainly caused by China, but it's easier to deal with Mexico and China, right? The manufacturing sector here is suffering. When you look at the numbers, it's more because of the entrance of China in the WTO, accession of China to the WTO, than anything that had to do with NAFTA, right? And that's something that I think probably Mike will talk about, is that whether we like it or not, China is going to be a key player going forward. And a country are going to have to take into account and keep in mind much more than we have in the past, right? And the final is immigration. But I wanted to talk about protectionism. At the end of the day, between the US and Mexico, actually, what you realize is of the exports of Mexico to the US, 40% actually produced in the US. They've changed, the production chains are completely integrated. So it's almost impossible to disengage them, right, at least in the short term. I think that's something that they realized. The second was actually shocking. It's one thing that the administration realized is anytime they tweeted about Mexico, the exchange rate depreciated, which meant that the Mexican goods became more competitive in prices relative to American goods. So instead of getting to their objective, which is actually trying to reduce exports or actually imports from Mexico, what they were doing is encouraging it, right? And I think when they realized that, you realize that there haven't been any new tweets or messages, that are very radical in that respect. You got to be very careful with what you say. But I want to say something on protectionism in the U.S. very quickly before I go. If you produce a Ford Fusion in Mexico compared to the U.S., because of auto parts and assembly, labor on auto parts, probably it's $1,200 cheaper to produce it in Mexico in Hermosillo than it is to produce it in Michigan, right? Fine, you say, okay, that's a problem because they have cheaper labor. But it's not only that. If you produced the Ford Fusion to export it to Europe, but if you did, it would be $4,300 cheaper to do it in Mexico than in the US, in spite of the fact that the logistics from the logistics from Mexico are much more expensive than the logistics from the US. And the reason is because Mexico has a much better trade agreement with Europe than the US does. And that means $2,500 in a car. So therefore, the competitive advantage is true it is in labor, it's true it is in auto parts, but it's also in the fact that now the US used to be the most open country in the world, the least protectionist country in the world. That's the past. That's way back then. Actually, when you look since 2008, the country in the world that has implemented the most protectionist, the number of protection measures in the world is actually the US. With obviously Europe not far behind. But so it is not true that the US is the most open, at least in terms of trade anymore. And let me finish, as I said, with just one thing. There's elections next year, and that's a challenge. There are elections in Chile, Argentina, and Mexico, right? And the following year, there are elections in pretty much the rest of Latin America. And there is one thing that is going to dictate what happens, and it's corruption. One thing we realized with Brazil is that, something they never did in the past. Now they're putting presidents in jail for corruption, right? But the impact is not only happening in Brazil, it's expanding to countries like Mexico, where one of the challenges for the present administration is the corruption allegations, and it's being a determinant next year in the election. And not only that, when you go to any country in Latin America, I don't know how many of you know the Brazilian company Odebrecht. Odebrecht is one of the largest construction companies, definitely the largest in Latin America, and one of the largest in the world. They were caught, a lot of corruption scandals pretty much in every country in Latin America, and that's changing the way business is done in Latin America. Right now, signing a contract, if you're working in construction in the area, you realize that, governments are much more looking at what's going on with companies, and the relation between companies and government than they were doing 3 years ago. That's bad in the short term. Maybe you're going to get less investment in the short term, but I like competition, so it's probably very good in the midterm. So that's why they say the beauty is in the eye of the beholder. Short term, yeah, that might be a challenge, but when you're going forward, the fact that you're asking your politicians and government to be more clean, open, and this, I think that's going to pay off. So I'll just start conclusions, and thank you very much.
Thanks. Yeah, I don't have any slides, so I'm glad there's some support for that. I don't think in my professional life I've ever seen so much optimism about Europe. And granted, my professional life isn't quite as long as some others, but I stood here a year ago and talked about Europe, and it was just after the Brexit referendum, and I only had time to talk about Brexit in the time allotted to me, and it was all bad. This year, you'll be happy to know that there's a bit of a different story to tell. I will address Brexit at the end of my comments, and that is still all bad. But in terms of the Eurozone, actually, like I said, I've never seen so much optimism, and it's based on both economic and political factors. So I'm going to lay out the case for all this optimism, and then I'm going to pour a little bit of cold water on it because there are quite a few risks that still exist in Europe. In terms of the economic reasons that everybody's so optimistic about Europe, and I should say most of the portfolio managers I talk to say that if you're not already in Europe, if you haven't already invested in it, you probably missed the trade. You're probably too late. So this isn't brand new. But we've seen in the US this bifurcation between hard and soft data. So all the confidence data, all the survey data has been looking great, hits new highs every month. But when you look at the hard economic data, actually it's not looking that great. So you see this big split. And you have seen that in Europe for a while, since the US election actually. But in recent months, that's actually shifted in Europe. So all the survey data, the PMI manufacturing data has been looking great. Greece is even seeing its manufacturing sector expand for the first time since I think 2009. So that says something. Even Greece is expanding. All the consumer and business confidence data is looking great. That's been the case for a while in Europe. But now the hard economic data is actually starting to turn around and meet that. So it seems like all this optimism is actually pulling the hard economic data up, whereas in the US it's not happening. So retail sales data across the Eurozone is looking better in the past couple of months. Industrial production's looking a bit better. New factory orders have been expanding in the past couple of months, particularly in the Eurozone's big economic machine, Germany. Consumer spending for those countries that actually report it regularly, it's been looking better. Unemployment's been coming down across the Eurozone as well. So the hard economic data is starting to match the soft economic data, and that is a reason for optimism in Europe. The second reason for optimism in Europe is really political. So we came into this year with an incredibly busy election schedule in Europe, off the back of Brexit in the UK and the US elections last year, and everyone was worried that populists would take over Europe in these elections. And that hasn't materialized, and it doesn't look like it will materialize across the board. And I think most of the optimism has come out of the French elections. So there were big concerns that Le Pen was going to win the French election. She wanted to hold a referendum to take France out of the EU, following the UK's footsteps. There were huge concerns on both sides of the Atlantic, particularly in Berlin, about this. And this guy who's only a year older than me threw a political party together about 18 months ago, ended up winning the presidential election, and then went ahead and didn't sweep, but won. He was the biggest party in the National Assembly election. So there's a lot of optimism about that. When I go to Berlin, and I go to Berlin a lot, I usually spend more time talking to the Germans about France than about Germany, and usually they're pulling out all of their hair over France. They're endlessly frustrated. I was in Berlin a few weeks ago, and they were absolutely euphoric over France. So in their view, and in the view of many investors, this is a real turnaround point for Europe. So France has long been a sick man of Europe, and if anyone can actually implement the labor market reforms in particular that France badly needs to find stronger, sustainable growth, it probably is Macron. I would highlight a few risks with this. Macron, his job, and he's vowed to come in and institute all these labor market reforms. But France isn't growing very much. And so if you go ahead and liberalize the labor market in a period when you don't have a whole lot of growth, what ends up happening is it's easier to hire and fire people, but you end up firing a lot of people rather than hiring a lot of people. So then you get a lot of people who are unemployed and on government benefits all of a sudden. So in the short term, actually, liberalizing the labor market is usually pretty bad for GDP growth, unless you're growing really robustly, which France is not. In the long term, actually, 5 years down the line, roughly, it'll start to bite and support GDP growth. But in the short term, it's not great for growth. So Macron's going to come in and put all of his political capital towards these reforms, which France badly needs. But it's hard to imagine why you won't see labor unions out in the streets burning tires, as you do every time a French politician tries to implement labor market reforms. So there will be a lot of opposition to this. And then also, it's going to be bad for growth. So I don't know how people in France are going to feel about that. I think it is positive that we have this new government in France, but I think they're going to face a lot of troubles, even though they have, the biggest party in the National Assembly, and you've got Macron in the presidency. I would also highlight that this narrative that populism is dead, we've already hit peak populism, I don't buy it for a second. So Macron's party won the National Assembly with about 30% of the vote. I don't think we should be excited about that. That's not much. And that's because there's been such a fragmentation in French politics, but also in European politics in general. I don't think that we've actually addressed any of the fundamental causes of populism over the past 10 years, roughly, in the Western world. And so even though we haven't seen populists come into government in European elections so far, I don't think we should consider populism dead. And I should highlight that, populist parties have on average done better in elections in the past year than they have since the post-war era. Also, populists don't have to be in government to have power. Actually, they often do much better outside of government in opposition, where they can sort of shout from the sidelines and influence discourse from there. So just because populists aren't winning elections, I don't think that we should consider them not a threat or not something to consider anymore. And of course, we do have populists in government in Europe, in Greece, Finland, Hungary, and Poland, among other countries. So they have actually gotten into government in some places. And if you want to think about the threat of populism, you don't have to look any further than Italy. I have long thought that the Eurozone or the Euro project will kind of live or die in Rome. And I still think that's the case. Thank you. Italy has to have an election by next May. It will probably happen at the beginning of next year. It will definitely not happen before September because a bunch of MPs in Italy get lifetime benefits if they hold the government together through September, so that's quite a good incentive. So I think probably early next year we'll have elections. The leading party, the PD, it's a center-left party, is neck and neck with the Five Star Movement, which is a populist party. It's hard to know what they stand for, but one thing they have said is that they plan to hold a referendum on Italy's membership of the Euro, so not the EU, but the Euro. It would be hard to leave the Euro without leaving the EU, though. And there are a lot of hurdles to the Five Star Movement actually pulling this off, if that's what they end up deciding they really want to do, as they've threatened. But you could conceivably see them winning the election in Italy, finding a coalition partner, possibly Forza Italia and the Lega Nord, so two smaller parties who are both pretty anti-European, holding a referendum. And, there's only one country in Europe where you saw support for the EU and the European project go down after Brexit. Everywhere it went up except for in Italy. So whereas there were worries about France going down this route before, the European project's pretty popular in France. It's really not popular in Italy. So you could conceive of Italy actually following in the UK's footsteps and having a referendum to leave the euro and choosing to leave it. There are a number of ifs in that scenario, but it could happen. Also, Italy poses another risk in terms of its banks. So when the euro crisis hit, a number of people had argued, look, we need, the euro is really, as a currency, it's really just a crisis mechanism. We need the Eurozone to be structured differently. We need a fiscal union and a political union and a banking union for the the Eurozone to be an optimal currency area, so for it to be sustainable. And there's only one area in which we've actually made any progress in those kinds of unions. It's banking union. And it's only been a little bit of progress. We haven't gone to a full banking union, but it is the one area where there really has been progress in the Eurozone. And it has been tested this year twice. First, it was tested in Spain. Spanish bank Banco Popular was resolved, so there were bail-ins, you had investors taking hits. And it was very successfully resolved, so everybody said, hurrah, banking union works. And then they turned to Italy. Italy has a number of smaller banks with pretty sick balance sheets. And they managed to find a loophole in Italy to the European regulation. So they started to look at how to resolve these banks, two small banks in their Venetian banks. And they ended up finding a loophole whereby they decided to defer to Italian bankruptcy law, which is pretty unclear. And as a result, they got around all of these bail-in rules, and so the Italian taxpayer is now on the hook for about 17 billion euros to resolve these two banks and help out a slightly smaller bank, MPS. So the whole idea that you wouldn't be foisting all the problems of the banks onto your population, onto the taxpayer, it's not really working out. And so it does throw up a red flag. It's the only area where we've really made progress in the Eurozone since the crisis. It's being undermined. Does that mean that it's dead? No. It means that, we've found some loopholes and they need to be closed, but you would need the political will to go ahead and close that. And bailing in your banks is pretty politically poisonous. So I think that's a risk for the Eurozone going forward. Now I'll switch gears a little bit and talk about Brexit. The UK sort of goes in its own category here. As I said a year ago, I stood here just after the Brexit referendum, And like most economists, I thought this was going to be immediately really bad for the UK economy. And that actually hasn't been the case at all. The UK economy has held up pretty well. Investment has held up surprisingly well. But private consumption has held up really well in the UK, too. I think what's ended up happening back a year ago, when Brexit happened, we all thought that Article 50 was going to be triggered within 2 days, because that's what David Cameron had told us. And then David Cameron resigned, and Article 50 to start the process of negotiating the UK's new relationship with the EU wasn't triggered until March of this year. So it's all been drawn out really far, really long, much longer than we thought. And so I still think it will be bad for the UK economy. I just think it'll take a little bit longer. And we're actually already starting to see some of the economic data turn. So private consumption managed to hold up in large part because the consumer was just leveraging up in the UK. So you saw private debt increase pretty significantly. Now we're seeing real incomes fall in the UK. We're seeing the savings rate fall pretty significantly. And like the US, the consumer really drives economic recoveries in the UK. So the private consumption has been the biggest component of GDP in the UK since 2012 and also before the crisis. So the consumer really matters in the UK, and we're seeing indicators suggest that actually private consumption is really starting to falter in the UK. Now the hope is that investment will come in and take over for consumption. I don't really know why any company would actually go into the UK given that they have no idea what the regulatory environment will look like post-Brexit. So I think we'll probably see a bit of an investment strike for a while. Investment, like I said, has held up better than I expected. I don't think anybody's pulling out of the UK aggressively, but I don't think anybody's going into the UK at the moment either. And I think that will continue until we have a sense of what Brexit will really look like. And there's been a big event between last year and now that I think does affect what Brexit will look like, and that's the UK had an election. So Theresa May, the Prime Minister, decided she needed a real mandate to negotiate on the UK's behalf. According to opinion polls, her party was set to increase their majority in Parliament, so they held an election and they just botched it fantastically. So they ended up losing their majority in Parliament. They've cobbled together a government with a small Northern Irish party, but if they didn't have a mandate before to negotiate Brexit, they certainly don't now. And so that will make it really difficult for Theresa May to go to Brussels and make really difficult concessions when she's negotiating Brexit. And so I think the outcome will probably be the same as it would have been before the elections. I still think the UK is headed for a hard Brexit. So I still think the UK will end up leaving the single market, giving up the 4 freedoms, so the freedom of movement of capital, goods, labor, and services. After all, the UK really doesn't want free movement of labor. That's mainly what Brexit was about, and you can't pick and choose between the 4 freedoms. If the UK did, every other European country would want to as well. So they're not going to open up that Pandora's box, I don't think. But the tail risks are a little bit higher. So the chances of a soft Brexit are a little bit higher now. You could argue that a lot of people voted the way they did in the election because they didn't like the way that the government was heading towards Brexit, towards a hard Brexit. So you could argue that some people were casting their vote against a hard Brexit. I think, honestly, I would have been, as a UK citizen, actually, I didn't vote in the election, but I would have been voting on Brexit terms. Joe Sixpack, or Joe Sixpint, I guess, in the UK, probably wasn't really thinking about Brexit. He was probably thinking about his benefits and more local politics. I think the tail risks of a really hard, an even harder Brexit are a bit higher too. So I think the UK really underestimates how much the rest of the EU doesn't really think that the UK has much to offer them in exchange for concessions. So when you talk to government members in the UK and ask them, why do you think the EU will make concessions, they'll say, well, we can offer security. We talk to the Europeans about British security, they say, thank God the UK is leaving so we can finally do something on the security front. So I think the UK, as Manuel has often pointed out, actually, we all focus on what the UK's position is. The EU's position is more important given that there are more stakeholders there. So I do think that the risks of a really hard exit where you end up getting to the end of this 2-year negotiating period that started with the triggering of Article 50 with no agreement at all, and the UK just kind of stumbles out of the EU. It's more likely, I think, that they'll come up with a transitional agreement that probably won't look so different from what the UK has now, actually, for a number of years while they try to negotiate a more comprehensive relationship between the UK and the EU. And I do think that will all be bad for the economy. So I recently attended a conference in the UK, and we were asked to come up with 2 good things about Brexit, and not a single person in the room could. We're all economists, to be fair, but I do think it will be unambiguously negative for the economy. I think the UK will probably avoid a recession, but they'll see growth falter pretty significantly. So the Eurozone has made some progress. There are some real challenges in terms of institutional developments there. I don't think populism is dead, so I do think we need to keep that in mind. And I think that Brexit will be bad for the UK. There are a couple of other areas in which Europe has a lot of progress to make as well. Migration policy. We don't read about it in the papers just because the media and public are bored of seeing pictures of refugees crossing the Mediterranean, but there are more refugees coming into Italy than there were piling into Greece across the Aegean. It's just, there isn't the attention span anymore for it. But Italy, which already has some challenges, as I've explained, is bearing the brunt of that. And also there's no European defense policy. So those are other areas that will be challenges for Europe going forward. I'll leave it there and turn it over to Mike.
Thank you. I'm going to talk about China. I'm not going to use slides. I like talking about China because you don't have to use slides because nobody believes their numbers anyway. So on that very point, one of the main things I do when I talk to people is I tell them how fast China's growing. And the reality is that China right now is growing about 8%. In 2014, when I went to conferences, I used to say to people, what's the lowest number in the room on Chinese growth? And people would say, well, it's certainly not 7. The government's wrong. It might be 6. It might be 5. And my answer was, whatever the lowest number in the room is, I want to be 1% lower than that number because I want to leave you with the idea that China is growing slower than you think. And where I am today is I went to a conference, and many of us belong to the same group. I went to a conference in February, and I made the announcement that China was growing 9. And one of the top economists in the United States almost had a heart attack because I made this announcement. He was apoplectically angry that I would say such a thing. And the reality is, if you need to think about China, you need to think about the United States in the 1920s and 1930s. China is largely an agricultural and manufacturing-based economy. It's a boom-bust economy. It goes on, off, on, off. It has about a 3-year cycle. So it bottomed in 2008 on the Lehman crisis, then it exploded with a massive fiscal stimulus. It bottomed in 2011 on the Japanese tsunami, and then it had a massive stimulus to make sure that Hu and Wen went out on a good leg when they left office in 2012 and Xi Jinping came in. And then they bottomed in 2014 into 2015 on their own corruption campaign. So it's a 3-year cycle, down on 8, down on 11, down on 14, 15. So they're going to be at the bottom sometime towards the end of 2018, sometimes towards the beginning of 2019. But right now, they're at the top. They're kind of, if you think of a roller coaster, they're at that point where the roller coaster is just hanging over the top and it hasn't started its steep descent yet. So if I had to give you a pattern, I'd say, yeah, I was right that in February, in the first quarter, they grew 9. In the second quarter just ended, they grew 8.5. Now they're at 8. The fourth quarter 7, then 6, 5, 4, 3. Towards the end of next year, they'll be going down sharply. Now, the goal here in China has less to do with economics than it has to do with politics. And what they've been after this year, and the reason that they got themselves to 9% growth early in 2017, is that Xi Jinping appoints new people to the party and government offices in September and October of this year. And the question is he in for 5 more years, or is he in for 10 more years, or is he in forever? And the answer is we don't know. But what he's done is he's focused the government on making sure that he had a strong enough economy, that he was in a position to put people that he wanted in power, and then we'll see what happens. His real goal is that in 2020 and 2021, the party has its centenary, the 100th year of the Communist Party. And it is absolutely mandatory that the economy be strong at the time that the party has its 100th year. How embarrassing would it be to say that in the 100th year they were in a recession? And you got to remember, the Chinese greatest fear, what happens there every day, and I say this to audiences all the time, is the party wakes up every morning and asks one and only one question. What do we need to do to make sure that the party is in power at the end of today? If that means reform, they reform. If that means repression, they repress. It's a very simple system. So I'm going to talk today about 5 themes and 3 numbers. Any of you that deal with China know that they love these kind of announcements, the 3 represents and the 5 orders and this. So we're going to talk about 5 themes and 3 numbers. The first of the 5 themes is she as the core of the Chinese government. Now, this is a title that was not given to Wen Jiabao and Hu Jintao, was not given to Jiang Zemin. It was given to Mao and it was given to Deng. And so it tells you how powerful she is that he's able to get the rest of the pieces of the Communist Party to say that he is the core. Now, part and parcel of that is that he's now going to be appointing these people for his second 5 years of government. He's already this year replaced the heads of all of the major regulatory and developmental bodies, the NDRC, the CBRC, the bank regulator, the CSRC, the stock market regulator. He's taken technocrats out of the banks and put them into positions of power as provincial governors and provincial party leaders. This is very rarely done in the past. So he's using the business sector as his bench, very much like what's going on in the United States today. And the question has always been, how deep is Xi's bench? And if you go into the business leaders in China, it's quite deep indeed, and they're way better than the government leaders because they've had real-world training as opposed to, technocrat training. So it looks to me like what he's going to do is he's going to ignore what's called the 7 up, 8 down rule, which means that if you're going to be over 67 at the end of your 5-year appointment, you can be appointed, but if you're going to be 68, you can't be appointed. And he's going to ignore that to keep Wang Xishan, who's the head of the corruption campaign, on his team. He will replace 4 of the other 7 people on the sitting Politburo. All of them will probably be much younger men who are his proteges. And that leaves him now at 58 in a position to remain in power 5 years after that. If he names someone in particular or picks someone that looks like they're at a high enough level that they would be the replacement in 5 years, we would still expect that he's going to be the puppet master behind the scenes for pretty much the rest of his life. And the question is, how long does a 58-year-old live? So you're going to be dealing with Xi for a long time. The second theme is filling the void. When Trump was elected and he pulled back from TPP, the Chinese rushed into that void. They rushed in and they've been spending money like madmen. They've gone in and they've bought all of the Philippine bananas. They bought all of the Malaysian oil. They bought all of the Indonesian cinnamon. I mean, anything that you're selling that will make you happy, the Chinese are in buying in large quantities, or they were in the fourth quarter of last year and the first quarter of this year. It's starting to cool down now. But they did that because they're basically buying good graces. I mean, if the Americans are going to be backing out, hey, look who's going to be your friend, it's us, China, we're going to be in here. They're also promoting basically a Monroe Doctrine in Asia, where Asia belongs to the Chinese. And they're going to control that area of growth. And since that area of growth is far and away the largest population in the world and far and away the fastest growing part of the world, it's something that everybody else in the world should be very, very concerned with. If you think about that part of the world, besides China and its 1.4 million people, maybe 500 million of whom are still at a low enough level of economic activity that they can be elevated easily and generate a lot of growth. You got another 100 million in the Philippines. You've got another 200 million in Indonesia, both of which are growing north of 8 right now. And their major trade partner is China. And then you've got other places like Thailand starting to come back, Myanmar freeing up, etc., etc. These are all huge places. Vietnam is 90 million people. Myanmar is 50 million people. North Korea is 50 million people. I mean, people just don't understand how big these countries are. And if you start elevating places like that, from $1,000 a year to $2,000 a year, it leaves a mark pretty quickly. So part of what he's doing here is the One Belt, One Road program, where he's going in and offering to build Chinese infrastructure, to have Chinese companies build infrastructure in these countries. The Chinese have done more infrastructure projects than anybody else in the world in the last 10 years. They're very efficient at it. They do it with their own workers. I mean, they bring their own people in, and then they don't leave. This is their way of infiltrating countries. You may have read recently that they've just built their first foreign military base in Djibouti. They're just opening that today. They've just floated their second aircraft carrier, their first domestically made aircraft carrier. They're now building their own long flight jets to rival Boeing. I mean, they're doing a lot of things that will help them promote China within the region. A lot of people say, well, what about the South China Sea? Well, it's theirs. They're the only ones with aircraft carriers. They're the only ones with the ability to project power in the region, unless the United States does. And the United States doesn't seem to really want to project power in the area. They're willing to maintain power in the area, but I doubt we're going to get into a shooting war with the Chinese. And the Philippines, the Vietnamese, the Indonesians, the others who are involved have basically acquiesced to the fact that the Chinese are going to make the rules in the South China Sea. The third theme is protecting your flanks. So China knows that it can't have a Monroe Doctrine in Asia, and it can't have this growth if the United States is going to be involved. So they're very happy that the United States has stepped back from TPP, and they want to make sure that the United States stays uninvolved in the area. So when Trump asked them to do something about North Korea, they cut off coal imports to North Korea. Now, they did it in February, and they import 100% of the coal that they're going to import in January. So we won't know until next January whether they actually cut off imports, but they did the public thing. They made the signal that they were doing this. They negotiated with Treasury to make sure that the yuan was not cited as a manipulated currency. And they made this agreement on allowing American beef to come into China. I work in the beef industry. The company that I work for, the largest cattle commodities traders in the United States. And we've been waiting for this for a long time. Well, what they basically did is they bought a lot of congressmen and senators with that, because there's a lot of people that raise, cow-calf places, like, it's places you don't think about, but it's places like Kentucky where the McConnell is from. It's places like Florida. It's not just Texas. It's the entire Midwest. It's the entire Northwest area where we are right here. These are big cow-calf areas, and so you pick up a lot of senators, which is more important than congressmen right now. The negotiation, it really isn't all that great, because you still have the country of origin labeling, and most American beef producers don't really have the ability to tell you where the animals came from. So it's going to be a long, slow rollout for beef to move into China. But again, they made the sign. They showed that they were willing to do these kinds of things. And they're going to continue to do this to protect their flank, to keep the United States off guard. The other thing they do to keep the United States off guard is they make sure that the Middle East is a mess, because the United States has a tremendous focus on the Middle East, and the Chinese do a lot of things that just kind of poke the bear and keep things going in the Middle East. The fourth theme is urbanization at home. The Chinese believe that this is the driver of their domestic economy. And so what they did 3 years ago is they announced that they were going to free 250 million slaves. Basically, people who did not have hukou registration, people who could not get medical care or education benefits where they were working because they were assigned to some town in the countryside that they had moved into the cities from. They basically allowed that 250 million people to have registration in any city but Beijing, Shanghai, Guangzhou, and Tianjin. And it was 3 years for the smallest cities, 4 years for the medium-sized cities, 5 years for the largest cities, never in the 4 biggest cities in the country. So we're now 3 years into that process, and we're finding hundreds of millions of people now eligible for benefits and therefore settling down in these smaller cities. And what it's doing is it's filling up the former ghost cities, some of the most underpopulated places in the country, and it's holding up property values, which has a lot to do with one of the bigger problems, debt, which we'll get to on one of the numbers. The fifth theme is that China is for the Chinese. I belong to the American Chamber of Commerce in China. In fact, I'm the only non-resident member of the American Chamber of Commerce. in Beijing. And I go there specifically because they set up what are called business investment opportunity trips, where they go into remote areas of China where you're never going to be able to travel on your own, especially if you don't have Chinese, and I don't. So you get to go to places, not just going to Xi'an, but then going 3 hours past that to Baoji and, seeing a city of 1 million people that most people don't know exists. And going into factories, going in, talking to the politicians and seeing where the free trade zones are and that kind of stuff. Well, I started going in 2005, I noticed a significant change after the Olympics, where before the Olympics, people would come up and take their picture with me because they'd never seen a white person before. By the Olympics, there were enough foreigners in China that didn't happen anymore. And China took a turn where, as the West went down, the Chinese would come to me and say, we don't really believe in democracy. You say, well, why do you say that? And they say, well, the closest democracy is Japan, and it's broken. Next is Taiwan, and it's broken. Then Korea, and it's broken. The United States, it's broken. The UK, Hong Kong, they're all broken. This was in 2008 and 2009. Who was going to argue? And so they got a very big streak of independence. Well, I've just, in the last 3 months, I've received 2 invitations to go to China on these business investment opportunity trips. Chinese only. The document was all in Chinese, and at the bottom it said in English, Chinese only. This is the American Chamber of Commerce in China. And I talk to people over there, and they've been watching for years now, where it used to be Chinese American and American Chinese, and about half the people who were in AmCham looked like the people in this room, but they went to school somewhere and they studied Chinese when they were young, and then they went to China 20 years ago and they'd risen to the top. Those people are all retiring and they're coming back to the United States, and they're being replaced by Chinese who are Chinese, came to America, educated in the United States, and then went home. And so there are less and less white Caucasian or just American participants. And now you've gotten to the point where they're not even going to speak English at the American Chamber of Commerce. More and more of these sessions are being done all in Chinese. And I say to people, China is for the Chinese. It's very hard to deal with. If you think of the companies that go to China, if China's growing as fast as it says it is, and I believe it is. I mean, I believe it's growing at 6-7% on a trend. Goes 3.9, 3.9, it bounces up and down, but I believe the trend is somewhere in the 6-7% range. The kind of profits you should be throwing off from that, you should have people killing each other to get into the country. But the companies that are the biggest, that have been there the longest, the Deeres, the Caterpillars, the Fords, the BMWs, they're not. In fact, many of them are leaving. Yum Brands, Starbucks, they're all starting to drift away. They're starting to sell to domestic entities because they just can't make money, and the Chinese can. The Chinese know the rules, which, as Mr. Silvia pointed out, are guidelines. It's not written down. So 3 numbers. The first number is a $500 billion trade surplus. The Chinese announced their trade numbers this morning. Their exports are growing 11.3%, and their imports are growing 17 point, who knows? I mean, past the decimal point's a joke anyway, right? So if they're growing 11%, the world's not growing 11%, so they're gaining market share in the export markets globally. And they are because they're more efficient at production than almost everywhere else, very much like the Germans, very much like the Japanese. But the main number that you should focus on there is that they said they had a $42 billion trade surplus with the world this month. 42 billion times 12 is $500 billion. That's $500 billion of cash going into China that's not going out of China. Now, where's that money going? Well, in the past, that money showed up in FX reserves because the government gathered up the random dollars and yen and pounds that came in and gathered them up and gave you yuan, and you had the money in the domestic economy, but they had the FX. Well, their FX exchange has gone up 0 in the last 6 months. It's rising. It's not falling anymore, but it's rising like, $8-10 billion a month. It's not going up very fast. So that means that somebody's got $500 billion in FX that flowed into the country that didn't flow out. Now, I don't know whether they have it domestically and they're re-dollarizing inside the country. I doubt that, because with the stability of the currency, there's not a whole lot of interest in holding dollars instead of holding renminbi. More likely is that it's people outside the country not repatriating dollars back into the country, very much like Americans do, not for tax purposes, but just for diversification purposes, to hold your dollars offshore. It does not appear to be that it's people taking dollars out of China and buying things in the United States, because that door has been slammed shut. We've heard the stories about Anbang buying the Waldorf Astoria in New York. Anbang tried to buy a building just down the street, and that was stopped. We saw Anbang try to buy 666 Park Avenue from the Kushners. That was not allowed. There have been a number of other deals like this have been shut down by the government. Now, if you're buying copper mines in Chile, if you're buying beef in Australia, they'll still let you do that. But if what you're buying is movie studios and hotels and residential investment, they've really slammed the door on that. Not just on the big corporate entities, but on the Joe Sixpack who wants to get $50,000 out and cobbles it up and buys $1 million house in Vancouver. So they're still making a lot of money, but a lot of that money is being held in private hands. To me, that's a good thing in China. That promises more growth, because I think the private sector is a better allocator than the government. The second number is debt. China has a record level of debt. It is now as high as it was in 2002. This month, Chinese debt surpassed the level that it was in 2002. China is currently an $11.9 trillion economy. In 2002, it was a $0.9 trillion economy. If debt was not a problem in 2002, debt is not a problem in 2017. Now, part of the reason that debt's not a problem in 2017 is because there is no such thing as debt in China. Now, Megan got up and she told you about the terrible banking system in Italy and how they had to find a back door in order to be able to recapitalize the banks and sell one of the bad banks to another bad bank. Because if a bank goes bad in the West, it has to be nationalized and a bad bank created and all this kind of stuff. In China, if a bank goes bad, it already belongs to the government. They don't have to nationalize it. And they already have bad banks. I mean, they don't talk about them like that, but they already know. They've already partitioned off that debt into bad banks. The other reason to be less worried about debt in China than most people are is because there's a significant tiering problem in China. Interest rates are much lower than they should be. You can borrow money in China at like 5%. But if nominal GDP is north of 10, and it is, then long-term nominal interest rates ought to be 10, right? I mean, that's what the Fed argues, right? That's one of the big arguments, isn't it, Paul? That long-term nominal growth in the United States is 3, so the 10-year note should be 3, and it's not, and we all get upset about it. Well, long-term nominal growth in China is north of 10, so their interest rate should be 10, and it's not, it's 5. So if you were a good businessman, what would you do? You'd borrow money at 5, and you'd find somebody who's growing north of 10, and you'd lend it to him. And that goes on a lot in China, but it happens in tiers, where I lend the money to Madeline. Madeline lends the money to Megan. Megan lends the money to Manuel. And so it gets counted 3-4 times before it gets to the last guy, who maybe invests it very stupidly. I'm not disagreeing with that. I'm just saying the amount of actual debt, from initial lender to final borrower, is counted multiple times. Now, there's a risk in that any one of those links breaks, it can roll downhill. But I think it's less of a problem than most people think. And then the final number is just that the yuan has been steady for 6 months. I use the yuan as the best indicator of where the Chinese economy is because it's a controlled number. The Chinese can make it go wherever they want. And they've basically held the yuan steady for 6 months after letting it weaken for a long period of time, which meant that they thought that they needed a weaker currency in order to balance their economy. They no longer, over the last 6 months, seem to think that. Why? Because they've been growing at 9%, and at 9%, they're growing fast enough that they don't need to. What'll happen in 6 months? My guess is the yuan starts to weaken again. Right now, the Hong Kong dollar is the weakest that it's ever been against the U.S. dollar. Now, it's a peg. I mean, it doesn't change. But in the last 3-4 months, it has weakened substantially. And I don't know what that means. I worry about that. I think it's another signal that Hong Kong is basically a dying city, that if you want to be in China, you're in Shenzhen or Shanghai or Beijing. If you want to be in Asia, you're in Singapore, and that there's no clear reason to be in Hong Kong, especially with the government taking more and more control of Hong Kong. Those are my 5 themes and 3 numbers, and I'm going to open it up to questions. I'll stand here and moderate for a bit, but if we have questions of anybody on the panel, hands up. Sure.
Oh, thank you. So your view is that the debt, I've heard numbers, 250% of GDP, whatever it is, 15 trillion, 16 trillion, doesn't matter because they can fudge their way through it? Is that? And then on that note,
Yeah,
how do they
kinda
ever,
like Japan, but
how
yeah.
do they ever become, like, unlike Japan, a global player in the capital markets and have global capital markets if they don't really have legitimate debt?
Well, so again, China being for the Chinese, they don't care if you invest in China, as long as all the money that's in China gets invested in China. And they have a more skewed Gini coefficient than anybody on the planet. So, I mean, there's a lot of wealth in China. How much of it's real wealth? That's a really good question, because this bad debt is owned by one guy who thinks he's amazingly rich to another guy who thinks he's amazingly rich. And if it turns out that neither one of them's amazingly rich, it probably doesn't mean a whole lot to the real economy. It just means that this guy and that guy have an issue, you know. But it's way up at the top. It's not like these people are affecting consumption or even investment because they're lending back and forth to each other. So I'm not saying that debt's not there, and I'm not saying that it might not be a problem. I'm just saying I think the consensus overstates the importance of that and the ability of the government to basically just come in and say, Megan, you're broke. Madeline, you're not. Let's go.
I have one other
Second
quick
question,
question. Yeah, it was as it relates to, you talked about the capital controls and how they've clamped down. I live in Los Angeles, and if you go downtown Los Angeles, you'll see 8 to 10 giant cranes. And I would say, I think 90% of those projects were all Chinese. They're all Chinese, some of the companies you mentioned. Does this clamp down have a ripple effect across some of these development markets in the United States, and is it going to affect our commercial real estate market, especially some of these new developments?
So location, yes. It's going to affect LA, it's going to affect Vancouver, it's going to affect Toronto, it may affect parts of New York, etc. We don't have those cranes in Memphis. They don't have them in St. Louis, they don't have them in New Orleans, they don't, you know what I mean? So most of us live in places or visit places where you can see that stuff, but 90% of America doesn't have that. So yes, it's going to have very profound local effects, but I don't think it's a big enough thing to affect us nationally.
Thanks.
Chris?
Megan, I wanted to follow up on your talk. Do you think that economists have a certain, did economists have a certain bias in favor of the EU when they look at Brexit and the other factors? Because, you know, when I look at it, Great Britain's a country. The EU, to me, is a bad idea. And you look at Italy, you outlined it very well, but what you didn't tell people is that the Italians are going to take the debt from those 2 banks in the Veneto, and they're going to subsidize all the bondholders. I see no hope that Italy can ever conform to the EU's fiscal rules. It's just not going to happen. So the hope is that the Germans will eventually acquiesce in what they call communitizing all of the debt. I mean, do we really want to bet on the EU in a scenario like that?
So you're essentially asking if the EU is going to survive or not. And I think...
Well, they changed the rules.
Right. I think the EU will survive. It's more likely than the euro surviving in any case. But yeah, I think if you go down the decision tree, you get to the extremes, and you get the euro breaking up or sticking together. There's a lot of optimism now, actually. I mean, you mentioned that they're going to have to change the rules. They are going to have to change the rules. And it's going to take a really long time, and they're not going to do it voluntarily, probably. They're going to do it when their backs are against the wall. That's how progress is always made in Europe. That's how the European project came into existence. So there is hope right now that Macron will reform the French economy and Merkel will be really impressed, and the two of them will go ahead and agree on risk sharing in Europe. But I just don't buy that for one second. I think Macron will burn all his political capital on domestic reforms, and the French will be pretty angry about it. And when it comes to turning to the European stage, he'll have used up all his political capital. And so I don't actually think that we'll see that as an impetus for reform in the Eurozone. I think, or the EU. I think, again, it'll have to come to a crisis. And what kind of crisis could that be? It could be the Italian elections. It could be a major bank needing to be resolved and bailed in, and a political leader saying, I'm just not doing it because it's politically poisonous. It's hard to guess, but I think, will the Germans eventually agree to risk sharing? Probably only if certain rules are in place. But I think it will happen long after Merkel's gone. I think she'll win the election later this year, by the way, so we're talking a really long time from now.
The Spaniard wants to
May
weigh
I
in.
comment to that? As a Spaniard and European, two comments. First, I disagree completely on the first point. If you read the Financial Times, Wall Street Journal, any newspaper you've read over the last year or year and a half, all you've seen, literally, is the British position on Brexit. So the fact that you say, no, all the economists are looking at Europe, no, actually, it's actually the other way around. For the first time ever, the British are great. When they put a white paper out, it's a real white paper. Did you see the white paper on Brexit? It was like 6 pages, and most of them were pictures. For the first time, they had no idea what they were putting forward, right? So, no, I think that they were to say. On the second, I'll go back to Mr. Silvia and Captain Barbosa, right? You seem to want Europe to play by the rules as like nobody else does. So rules are, nowadays, they're not rules, they're guidelines, right? You're talking about European banks. Yeah, hold on. I want to remember Fannie Mae, Freddie Mac, Citi, X, Y, and Z in the country that has the best institutions in the world. And nothing happened. It's perfect. So if Europe does it, it's a problem. If the US doesn't, it's not. Forget it. That used to be the way, that Europe was too orthodox. That's not the way. There are loopholes, yeah, and they apply them. One thing that the people don't see on the Italian rescue is that they sold the assets, right? They were good assets for €1 to the largest bank. So in one shot, it's true that they did, but the good assets, they gave them to the good bank, to the bank that was also hurting, so they help actually recapitalize the good bank, the one they wanted, at the same time. Is that fair? Forget it. We're not talking about fairness. We're not talking about fairness here in the US in 2008, 2009. That's the way. Will the euro, I said this last year, will the euro be here in 5 years? Well, yes, definitely. Will all the countries be here? Probably not. Who knows? But I just want to keep you guys with one idea. If anybody had asked whether you would have banking union in Europe today, 5 years ago, I think nobody in the US and nobody in Europe would have said yes 5 years ago.
It's still don't.
Right? And we're here. Is it what it should be? No. Whether we will have, I think we'll have some risk-sharing mechanism in 5 years. Definitely. Probably even sooner than that. Will it be what we all want it to be? No. It's going to be some zombie of thing, because that's the way Europe works. You cannot think of the same way you cannot think of China by American standards. I think it is clear in a lot of these things you cannot think of Europe and how Europe works by Anglo-Saxon. I won't say American, I'll say Anglo-Saxon, British standards as well. Because Europe is moving forward in that sense. And I agree with Megan in a lot of the things she said.
That's right here, and then in the green shirt, and then Madeline.
We have all these surpluses from some of these big companies that they're wondering, can we bring it back here? And my question is, why are they unilaterally thinking of bringing it back here? Are you seeing any of it going to South America, or do you see opportunities where they actually ought to be thinking in that direction rather than just here?
This is a very personal opinion, I guess. I think that's wishful thinking, the fact that companies, just because you have a small tax change or tax break in the US, they were going to bring tremendous amounts of funds back to the US. A lot of those companies are investing outside of the US because the returns are higher outside of the US than they are here. It's not like that money is idle in a bank account somewhere and they say, oh, look, we got a tax break in the US, let's bring all these funds back. Right? Why would they? You say, oh, they're going to come back, they're going to invest. Companies are not investing in the US. Investment has been a problem for the last few years. So what makes anybody think that they got more money they would be investing when they were not doing it in the past?
My question is not bringing it back to the US.
They are. That's what they're doing. They're investing elsewhere. I mean, when you see the flows, part of the reason why Latin America did not have a collapse, right, is because money was flowing into Latin America, right? Well, other times you would have a really collapse of funds going to the region. Now there isn't. I mean, I think the best example is Argentina. Argentina defaulted on its debt. How many years ago was it? I can't remember anymore. It was like 5 years ago, something like that, right? And they just issued a 100-year bond, and people are buying it. And in the last 100 years, they defaulted, I think it is 5 times, 6 times. So the likelihood that they'll default on that bond is almost 100%, right? In particular, when you look at their numbers. Still, people are buying it. That's a different issue. There's enough liquidity out there that people are chasing returns. So yeah, companies are investing in Latin America. They're investing everywhere they can.
My question to the panel is, what is the impact digital currencies having on the global economy?
Oh, sorry, can you repeat the?
What
Cryptocurrencies.
impact is digital currencies having on the global economy?
I'll say, from what I see, right now, marginal, still, right? That does not mean that eventually it will play a big role. Right now it's small, but that's what we're seeing. But we're looking in the rearview mirror, right?
Yeah.
Looking forward is a different story. It's becoming more important, in particular in certain transactions.
Megan?
And going forward, I think the biggest impact will be through financial services and banks and being able to boost their profit margins.
I mean, the follow-up is, I see a big challenge of U.S. banks adopting, the euro. The European market is destroying the U.S. So I'd really like to hear from the gentleman representing the U.S.
Well, I'll leave the credit issues to Chris and talk about the banking credit issues with cryptocurrencies. The one comment I would make is that, again, if you hold a $10 bill and it's a 3x5 index card, does it really make a difference if it's a 5x7 index card? It makes no difference in terms of economic activity. So the form that you hold money and pay for transactions makes no difference with respect to economic growth.
So, from my point of view, the Chinese are on the verge of issuing a cryptocurrency based in Chinese renminbi, owned and controlled by the Chinese government.
Yeah.
So ask yourself, if you're a drug dealer and you're trying to sell a lot of cocaine, and right now you've got a pallet 4 foot by 4 foot by 4 foot of $100 bills in order to move that money, and you can now move that in a cryptocurrency without touching the SWIFT system through the Chinese banking system, and the transaction is seen, but they don't care. They don't care about genocide in the Sudan. Why should they care if you're dealing drugs? Why would the Chinese allow this? Because they can steal a 10-year march on making the renminbi an international currency overnight. Why wouldn't they do this? Well, I mean, there's all kinds of issues about why you wouldn't do it. They're thinking about it. So cryptocurrencies may be a lot closer than the average person thinks.
Yeah, can I just add to that? I went to a SWIFT conference about a year ago, and all anybody talked about was China and the renminbi, and then also distributive ledgers. And the only thing that connects them is that China's building up its own financial plumbing. So it can easily circumvent the financial plumbing that we already have, and so that can be a tool for foreign policy.
Manuel?
On Brexit, will the pay to exit affect their economy, and how do you think that is going to play out?
Yeah, so the bill for the UK to exit, it's wavered a lot in the past couple of months. It could be as much as 100 billion. It could be closer to 60 billion. They'll probably come up with something closer to 60 billion, I think. That will still have a big impact on the UK budget, so it will affect their public finances, which already aren't in fantastic shape. But it probably won't produce a huge drag on the economy as such. So you could see, crowding out of the private sector a little bit, but just because the debt level will be so much higher. But it probably won't be a huge impact on the economy. It will also affect the EU budget, by the way, and a lot of public finances in other European countries that are reliant on the big pay-in from the UK for funding schemes in their own countries. So it will affect them as well.
I had a question for Manuel. The ongoing investigations in Brazil seem to take it from your comments that you see this as a sign of strength of the institution's functioning and chasing it to its end, and your graph of the CELIC rate going up, and the central bank's independence and its ability to control inflation. Now, I believe they're lowering interest rates. If you're a long-term investor, I sort of, in reading between the lines, you see this as strength in the institutions and reason for confidence if you've got a intermediate to longer-term outlook. Am I interpreting that correctly?
Yes. Yes. Yes, given that it happens. The first thing that has to happen is you have to have investigations, you have the institutions that are independent, and you have to have judges and institutions that go after in this case, the presidents. So you're talking big time. And that's happening in Brazil. In Brazil, actually, the central bank is quite independent, and you can see that. I mean, you just look at the numbers and you see how they reacted to inflation, regardless of everything else. The judges, the judicial system in Brazil is actually works quite well. So that gives you, in the case of Brazil, that's quite more positive than in the case of Mexico, for example, where the judicial system probably is not as strong in other places. Everything is relative, and we're talking Latin America, so you cannot compare it to the US. Given that, the way the economy works, or has worked for centuries, it has been through a lot of, from big corruption to petty corruption, right? And in that context, the fact that you're doing this is a good sign. However, the question is whether you will move forward and really change the things that need to be changed, and in Brazil, they haven't happened forever. For example, you need a pension reform in Brazil, because in Brazil, there were people who could get, literally retired 40 years old, right? If you were a civil worker, right? And forever. I mean, if you work at the central bank and so on. So there's a lot of things that need to go on beyond corruption for the economy to really be stronger down the line. It's a good sign, yes. It's something it's a necessary condition, but I don't know whether it is a sufficient condition to guarantee, the long-term growth. But we're talking, Brazil is one of those countries where it was very surprising during the last cycle, because usually in Brazil, when you think it's going to grow a lot, it never does. When you think it's going to recession, it never does. And in the last cycle, it went up to growth of 5%, which was crazy. Everybody said, oh, this is a new Brazil. And then it went down into recession, 3%, which normally never happens. Brazil will grow through 2%. Yeah, that's easy. The question is whether it can do a jump and grow 3.5%. And in an economy like Brazil and this size, which is like the third in the world, or fourth in the world, in population, whatever, can be very significant.
So one of the questions on Brazil and how fast they're going to resolve their corruption problem. Temer is currently at a 7% popularity rating. He's under indictment. They've passed the indictment. For him to be indicted, 2/3 of the sitting Congress has to vote for him to be indicted. That's not likely to happen because 50% of the sitting Congress is under indictment for corruption. 50%. I'm not kidding. So the betting right now is that they will hold him up long enough to pass the pension reforms, and then a second round of indictments will be brought against him, and he'll be impeached out, and then they'll elect the next corrupt guy to run Brazil. But it's not clear there are enough non-corrupt guys in Brazil to have a non-corrupt government.
John, could you characterize the importance of corporate tax reform to your economic forecast?
For us, again, changing the corporate tax reform is really changing the cost of capital. And if I can lower the cost of capital, I can probably improve the capital put in place, and I can improve productivity, so it probably would improve economic growth. I think, again, if you go with a 30% tax rate and probably do some expensing and do the territorial, you can probably add 0.2 to 0.3% at the pace of economic growth. Now, I think that is doable if that's what they want to do, but as I've said to other people, oftentimes the great is the enemy of the good. If you want to do something spectacular, that's wonderful, but if you want to get something done, just give me a little bit and I'll take it and run.
If we have exhausted you, we're going to take a break.